Behind the stability of America's economy lies a story of secret meetings, fierce political battles, and a relentless pursuit of financial security. In America's Bank, we uncover how the Federal Reserve was born out of economic chaos and distrust, transforming the way the United States manages its money and influences the global economy. This isn't just a history lesson. It's the tale of how power, vision, and compromise created one of the world's most powerful financial institutions. This book dives into the history and complex journey behind the creation of the Federal Reserve System in the United States. It's a narrative about political wrangling, economic anxiety, and the pursuit of a national institution that could stabilize the financial system. The author, Roger Lowenstein, is a renowned financial journalist and author with a deep understanding of economic history and its modern implications. With a career spanning publications like The Wall Street Journal and best-selling books such as When Genius Failed and Buffett, The Making of an American Capitalist, Lowenstein has built a reputation for unraveling complex financial stories. In America's Bank, he dives into the intricate details behind the formation of the Federal Reserve, using his sharp insight and thorough research to shed light on one of the most pivotal developments in American financial history. America's financial turmoil, the need for a central bank. At the turn of the 20th century, the United States had experienced a series of devastating financial panics, most notably the Panic of 1907. These crises caused widespread bank failures, massive losses for businesses and individuals, and a shaken public confidence in the banking system. The country had no central institution to oversee the banking sector, no unified currency, and no mechanism to respond to financial emergencies. While other major economies had developed central banks, the U.S. relied on a patchwork of private banks and fluctuating regional currencies, which left it vulnerable to economic instability. The push for reform, key players, and conflicting visions. Several prominent figures emerged as champions of financial reform, each bringing their own vision for a stable U.S. banking system. Among them was Paul Warburg, a German-American banker who had seen firsthand the benefits of the European central banking systems. Warburg became a passionate advocate for a U.S. central bank, promoting it as a way to prevent future crises. Another pivotal figure was Senator Nelson Aldrich of Rhode Island, a powerful leader in Congress and a proponent of big business. Aldrich understood that while Wall Street was resistant to government interference, the U.S. economy needed a cohesive system to manage its finances. He eventually became convinced that the nation needed a central bank, but one that would have limited government oversight. Opposition to the central bank idea was fierce. Many Americans, especially farmers and small business owners, viewed central banking as a tool of Wall Street and a threat to democracy. Fear of centralized power had long shaped American politics, and the idea of creating a central bank sparked anxiety about financial elites controlling the country's money supply. The Jekyll Island meeting, crafting the Federal Reserve blueprint. The process of creating the Federal Reserve began in earnest at a secretive meeting on Jekyll Island, Georgia. In 1910, a group of bankers and policymakers, including Warburg and Aldrich, gathered to discuss a plan that could pass through Congress. The cloak-and-dagger nature of the meeting has fueled conspiracy theories, but at its heart, it was an attempt to draft a plan that balanced public and private interests while ensuring economic stability. The result was a proposal that struck a balance between those who wanted a strong centralized authority and those who favored a decentralized system. The plan included regional reserve banks that would operate independently but be overseen by a central board in Washington, D.C. This structure aimed to reassure Americans who feared concentrated power while creating a cohesive national banking framework. Woodrow Wilson's presidency and the fight for ratification. With the election of President Woodrow Wilson, the central banking proposal found an unlikely champion. Wilson, initially skeptical of centralized power, grew convinced of the need for reform after the Panic of 1907. His involvement was crucial, as he managed to navigate the complex political landscape and bring together diverse factions in support of the Federal Reserve Act. The act faced fierce opposition in Congress, with critics arguing that it would grant too much power to bankers. However, Wilson was able to persuade key Democratic leaders to support the bill, presenting it as a necessary compromise for the nation's economic health. Finally, in 1913, after intense debate and numerous revisions, the Federal Reserve Act was signed into law. The structure of the Federal Reserve, a unique American solution. The Federal Reserve System established 12 regional banks, each serving a specific area of the country. These banks would operate semi-autonomously but under the supervision of a central board in Washington, D.C. This unique structure reflected the American desire for both centralized oversight and regional independence. The Fed was given authority to issue currency, regulate banks, and manage the money supply. For the first time, the U.S. had a unified system to oversee its banking sector and respond to financial crises. Impact and legacy of the Federal Reserve. Since its creation, the Federal Reserve has played a crucial role in stabilizing the U.S. economy. It has navigated numerous challenges, from the Great Depression and World War II to the 2008 financial crisis. While it has its critics, the Fed's existence has provided a level of stability that was absent before its founding. Today, the Federal Reserve is one of the most influential central banks in the world, setting monetary policy that affects not only the U.S., but also the global economy. Key takeaways from America's Bank. Financial stability requires a strong institution. Lowenstein illustrates that a fragmented system cannot effectively manage national or global economic shocks. The Fed has since become a model of centralized financial oversight, which has helped prevent the panics that were once common. Balancing power and regional interests. The structure of the Fed reflects a uniquely American compromise, balancing centralized power with regional independence. This structure has allowed it to address local and national concerns effectively, helping to prevent a concentration of power. Navigating public fear and political opposition. Lowenstein highlights the difficulties of implementing such a transformative institution in a democratic society. The Fed's creation required overcoming deep-seated fears about centralization, proving that even the most controversial reforms can succeed with the right leadership and compromise. The role of leadership in reform. Figures like Warburg, Aldrich, and Wilson were instrumental in the Fed's creation. Their efforts show the importance of leadership in navigating political and public opposition to bring about necessary change. Lowenstein's America's Bank serves as a powerful reminder that even in the face of intense opposition and complex politics, transformative change is possible. By understanding the struggles and decisions that led to the Federal Reserve's creation, readers can appreciate the importance of strong institutions in maintaining economic stability and fostering growth. Whether you're interested in economics, politics, or history, the book provides valuable insights into the power of persistence, compromise, and leadership in shaping our world. Thanks for listening. Please subscribe for more insightful books like this.